Hey everyone, welcome back to Corporate Decoder, the place where we untangle the complicated world of company finances so you don't have to. Get ready, because First Real Estate Investment Trust of New Jersey, or FREIT, has just dropped their latest quarterly report, and let's just say there are some interesting numbers in here that tell a story. Before we dive in, if unraveling financial statements like this is your jam, do me a solid and hit that subscribe button. And hey, we've got a fantastic community over on Discord to keep the conversation going with the link in the description below. Check it out. Now, FREIT is a real estate investment trust, basically a company that owns and often operates income-producing real estate. They've given us a look at their books for the period ending July 31st, 2025, and it's a mixed bag. Let's start with the big picture on their balance sheet, which is like a snapshot of what they own and what they owe. As of July 31st, 2025, their total assets stood at about $150 million. That's down from about $162 million at the same time last year. What does this mean? Well, it looks like they've been selling off some assets or paying down debt, as we'll see later. A huge chunk of their assets, around $90 million, is tied up in real estate properties. This is their core business, the buildings and land they own and rent out. They had about $14.6 million in cash and equivalents. That's a bit less than the $49 million they had last year. Not a huge difference, but it's something to keep an eye on. Now, for the money they owe, their mortgages payable, which is their debt, came in at roughly $121 million. This is down from nearly $129 million a year ago, which ties back to that decrease in total assets we saw. It seems they're actively working to reduce their debt load. Looking at their equity, the stake that owners have in the company, it's around $33.7 million. That's a slight increase from roughly $33.3 million last year. Moving over to the income statement, this tells us how much money they made and how much they spent to make it. For the 9 months ending July 31st, 2025, their total revenue was about $21.7 million, a small increase from $21.4 million in the same period last year. Their main source of income, rental income, was around $20 million for the 9 months. This is up slightly from $19.6 million last year. On the expense side, their total operating expenses were about $15.2 million last year, which is a good sign, meaning they managed their costs better. Now, this is a big one. Last year, for the 9 months ending July 31st, 2024, they had a massive $15.7 million litigation settlement net of fees. That's pretty much gone this year, which is why the net income looks so different. Without that one-time boost, we can see the underlying performance of the business. For the 9 months ending July 31st, 2025, their net income attributable to common equity was about $2.3 million. Compare that to a healthy $14.8 million in the same period last year. That huge drop is mainly due to that one-time litigation settlement we just talked about. It's like comparing a good regular Tuesday to a day you won the lottery. The lottery day looks way better, but doesn't reflect your everyday life. This translates to an earnings per share of about 32 cents for the current 9 months, down from a very strong $1.99 last year. Again, that's largely due to the absence of that large settlement payment. Now let's look at the cash flow statement, which shows how cash is actually moving in and out of the business. For the 9 months ending July 31st, 2025, they had about $3.9 million in the prior year. This decrease in operating cash flow is mostly because last year had that big litigation settlement. If you strip that out, the core operations are what we need to focus on. In their investing activities, they generated about $9.3 million. This came from things like buying and selling US Treasury securities. And financing activities used up about $14.1 million. This was largely due to paying back mortgages. They paid down about $6.9 million in mortgages, which explains why their overall debt is decreasing. Overall, their cash position decreased by about $900,000 to $18.3 million. This is another indicator that they're using cash to pay down debt and invest in their operations. It's important to remember FREIT is a REIT, meaning they have to distribute most of their taxable income to shareholders. This structure can influence how they manage their finances. They're talking about how they value certain assets like US Treasury securities and interest rate swap contracts. These are measured at fair value, meaning their current market worth, which can fluctuate. For example, their investments in Treasury securities were valued at about $20.5 million This section details their loans. They have mortgages on properties like Steuben Arms, Burden Court, and Westwood Hills. The interest rates vary, and some of these loans have upcoming maturity dates. For example, the loan on the FREIT Shopping Centre for 25, and they're working on extending it. They also have a credit line with Provident Bank, which is renewed and has $13 million available. They also have tenant security accounts, which are basically deposits from tenants. These total around $867,000. FREIT breaks its business down into two main parts, commercial properties and residential properties. They measure performance using something called net operating income, or NOI. For their commercial properties, revenue was about $5.6 million for the 9 months, but their NOI, which is a measure of profitability before some other costs, drops significantly by about $565,000, or over 25%. This is largely due to lower occupancy rates at places like the Preakness and Westwood Plaza shopping centres. It sounds like they're really struggling to fill those spaces with the Preakness and Westwood Plaza shopping centres. It sounds like they're really struggling to fill those spaces. On the residential side, things look a bit better. Revenue for their apartments increased by about $641,000, or 4.2%, while NOI also nudged up by about $475,000, or 5.3%. Occupancy rates are also strong, close to 97%. They mentioned that average rents are going up, which is good news for them. The commercial segment saw its average occupancy drop from about 50.9% to 48%. That's a nearly 3% drop, meaning fewer stores are open and generating rent. While the residential segment saw a slight increase in occupancy from 9 to 6.9%, which is great to see, the drop in commercial NOI really pressured their overall NOI, which went down slightly even with the residential segment doing well. In their management's discussion and analysis section, they talk about the current economic climate. They mention that while inflation and unemployment rates have increased slightly, the Federal Reserve has kept interest rates steady. This uncertainty around interest rates and tariffs could impact their commercial tenants. They also present adjusted net income, which is a way for them to show performance excluding some unusual items. For the 9 months, adjusted net income was about $238,000 last year. This increase is mainly due to lower legal and administrative costs. With that major litigation settlement from last year gone, the underlying business looks stronger, but it's important to remember that the prior year's results were boosted by that one-off event. Looking at their funds from operations, or FFO, which is a common metric for REITs, FREIT's FFO was about $4.9 million for the 9 months, up from $3.5 million last year. Their adjusted funds from operations, or FO, which they consider a better measure of performance, came in at about $4.6 million, up from $3.1 million. This improvement is driven by lower expenses, especially in general and administrative costs. My take, FREIT is navigating a slightly challenging economy, particularly on the commercial side where occupancy rates are definitely a concern. They are doing a good job of managing their expenses and reducing debt, which is positive. However, the significant drop in net income this year compared to last year is primarily due to the absence of a large one-time item, not necessarily a fundamental decline in operations. The residential segment seems to be the stable engine here, providing steady income and occupancy. The big risk remains on the commercial side, especially with those high vacancy rates at Westwood Plaza and Preakness shopping centres. They need to find a way to revitalise those properties or fill those spaces quickly. Alright, that's our breakdown of First Real Estate Investment Trust of New Jersey's latest financial report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.